Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be reporting flows initially for the conventional fund business for the week ended October 8th, 2014. And we'll talk a little bit about ETF flows as well because there's a little dichotomy in there. We actually had a pretty good set of inflows here this week. About $18.2 billion entered the conventional fund business. This is the third consecutive week we've actually seen inflows into the group. And how it broke out was a little bit different though. And I think you're going to be a little surprised what will happen considering we've actually had some pretty good economic news. But unfortunately, and actually the markets have been showing over the last 2 days, people are very concerned with the good news. Even though the Fed came out and FOMC met and said, hey, listen, we're concerned about global growth. We're not going to raise interest rates anytime soon. I think investors are still thinking that maybe the economy is too good. So it's back to those kind of Schadenfreude days where we look at somebody and see good things and we expect some bad responses from that. And that was one of the reasons. So the VIX actually was in its highest territory. We saw it get on last Friday up to about 18, which is quite a jump from what it had been. It ended up settling around 15. But nonetheless, we've seen the VIX actually just skyrocket. And really, it's been kind of strange because during this week that we're reporting, we saw the largest decline that we've seen in 2 months, and we saw the best gain in the Dow in over a year, all within 1 week period. So really, the volatility has stepped up and really has had some big impacts on it. And again, we had good ISM numbers, a little bit low, but again, in the expansionary areas, we had some good numbers out of Alcoa reporting its earnings. So really, overall, we've had some good news, but really people are very, very concerned about the overextended market, and maybe they think it's time for a breather. In fact, we know the Russell 2000 entered that 10% breather time period just recently. They've actually been down 10% from the March highs. So that really brings us into the flows day and what happened. And let's give you a breakout of what happened for our macro groups. In the equity group, we saw about only $300 million in net new money come into their coffers. Taxable bond funds, on the other hand, remember, people are kind of worried, risk is on. $7.9 billion of money is into taxable bond funds. That's a record, by the way, all going back all the way to 1992. If we look at muni bond funds, they took in about $500 million of net new money, and then money market funds saw $9.5 billion of money enter their coffers. So really, it was quite a story. But as I break this out, I think you'll see why I'm a little bit amazed at how this all occurred. Let's take a focused look at equity funds now. Equity funds, again, took in about $300 million net new money. It's the first week in 3 they've actually seen net inflows. But if you take a look to the far right, you see that they actually have pretty good returns. For the first week in 5, we've seen a 0.6% return. Well, not even 1%, but again, it's for the week. Well, how this broke out, we took a look at domestic equity funds. They actually lost about $200 million, the 7th consecutive week that we've seen outflows. But ironically, even though we're hearing ISIS, beheading another person and actually, causing some, attacking a city in Syria and the like, we're actually seeing non-domestic equity funds still taking money, about $500 million in net new money coming into their groups. And this is the first week in 3 that they've seen net new money. So there was really a dichotomy in play. Well, if we take a look at the actual outflows, about $200 million of those outflows on the domestic side were from mid-cap funds. And then if we take a look at the flows to the international side or non-domestic side, we saw international equity funds taking about $400 million and emerging markets taking in about $100 million. Again, not a big number, but again, positive, a little bit surprising. Well, let's take a look at where the real dichotomy occurred, and that's on our ETF. If we take a look at exchange-traded funds for the second week in a row, we have seen outflows, this time to the tune of about $7 billion. And where this actually kind of got the big chunks going is we saw money coming in to iShares Core S&P 500, about $2 billion. iShares Russell 1000 value took in about $300 million. But where we saw some of the big money leaving was the Spider S&P 500, SPY, lost $3.9 billion. We saw ProShares, QQQ, lose about $2.4 billion. So there was just some big numbers as the institutional investors on the ETF side, these are the authorized participants, really did not want to be holding on to inventory during this time of increased volatility because really nobody knows where this shoe is going to drop until maybe earnings season gets reported on. Well, let's take a look at where one of the bright areas was, and that was in flows into fixed income funds. Flows into fixed income funds for the 9th consecutive week. We've seen flows come into this group, $7.9 billion. It's a record amount. It's the first week in 5. We've seen plus side returns, 0.21%, and we've seen flows, again, for 9 consecutive weeks. So kind of amazing. Where we saw the money coming in, though, is really kind of in that middle area of risk. Corporate investment grade debt funds took in about $5.8 billion, while we saw loan participation funds losing money. We'd expect that, though, because of what the Fed had said. But again, this is the 23rd consecutive week that we've seen inflows into corporate investment grade debt funds. Now, if we take a look at the high yield side, high yield actually took in money again. Remember, this is a risk off move. Well, I don't think so. High yield funds saw the next largest group come in with about $400 million. And by the way, that's the first week in 6 that high yield funds have seen money coming in. So people were concerned. So during this risk-off period, high yield taking in money? Well, maybe some of these were moves due to people jostling out of their funds. We know that Bill Gross actually went over to Janus funds, and maybe some of that money is leaving and going into other areas. So maybe we can't relate it quite as clearly there. But we know there was a little bit of a reversal. We saw that the government, treasury, and mortgage funds on the open-end side actually losing about $100 million. So it doesn't look like there was a risk play in the open-end funds. Let's take a look now on the ETF side. This is a little bit different story. ETFs saw $4.8 billion of money come into their fixed income coffers. This is the second best inflow that we've seen since we've been tracking ETF flows into fixed income funds. It's the first week in 6 that we've seen actually positive flows. And at the top of the list, we saw iShares 1 to 3 Treasury bond ETF taking about $1.6 billion. And then if we look at the iShare Core US aggregate bond fund, they took in about $800 million. And then on the flip side, of course, we saw money leaving TIP funds. The iShare TIPS bond lost about $200 million. Well, not surprising, right? Nobody's really concerned about inflation-protected securities, at least not this week. Well, let's see now what happened to the muni bond fund side. They've been on their merry old way, saw about $535 million enter their coffers. It's the 9th consecutive week that we've seen inflows, and it's the 3rd consecutive week that we've seen plus returns, this time to the tune of just 0.16%. But again, positive returns nonetheless. And on the national muni side, if we take a look at single state national muni, national munis took in, again, the lion's share, about $526 million in their coffers. And by the way, this is the 13th consecutive week that group has seen inflows. So it's really been quite a story for muni bond funds. Well, with the increased risk, we do expect investors to put more money back to work in a money markets fund. So let's take a look at our money market numbers. Money market funds for the 3rd consecutive week saw $9.5 billion of money flows into their coffers. How it broke out is taxable money market funds took in about $7.5 billion. And how that broke out, if we take a look at who the players were, institutional investors padded the coffers to about $2.6 billion, while the retail investors, surprisingly so, actually put in more money, $4.9 billion. And again, this could be a little bit of a hangover from that Bill Gross story, people trying to find where they're going to put their money. Maybe they put it back to work in money market funds until they decide whether they want to go with double line or another product. But if we take a look at the tax-exempt side of money market funds, we saw about $2 billion of inflows into that group. So overall, all groups took in money, but it was really a little bit of a lopsided event. We saw a little bit more fear on the ETF side, and we saw a little bit more greed on the open-end fund side, and that's kind of unusual. We haven't been seeing that quite so often, actually. We've been seeing a little bit on the opposite side, where the institutional investor, authorized participant, actually been putting more money to work in the equity markets and less so by the retail investor. Well, this brings us to the end of the conversation, and I'm looking forward to next week and what's going on, because in the last 2 days we've seen a big meltdown in the market. We've seen a lot of money actually just get crushed out of the markets just from pricing, and a lot of people are predicting a 10% correction. We have seen 10% corrections in probably gold and oil and actually the Russell 2K, as I said before, but really there isn't a reason for it unless we go back to the idea that geopolitical uncertainty is actually a key aspect that people are looking at, because so far we've seen pretty good earnings reports for the 3rd quarter. So I guess we're just going to have to wait till next week appears. One of our analysts talks to you about the flow scene. But until then, if you want to go ahead and take a look at a deeper dive at what the data says to you, you can go to our site, lipperusfundflows.com, and do a deeper dive on that. But if not, join us next week. One of our analysts will be talking to you about the flows trends for that week. My name is Tom Rosine. Thanks for joining me today. Wishing you the best in your wealth planning and creation.